Hello, I'm Fiona Cincotta here at StoneX, and we're talking after Jerome Powell gave us his outlook for the potential impact of tariffs last week, and as the IMF downgraded its growth outlook for the US today. To help me unpack this and more, I'm joined by Kathryn Rooney Vera, Managing Director and Chief Market Strategist at StoneX. Thank you for joining me, Kathryn.
My pleasure as always, Fiona.
So, yes, we heard from Federal Reserve Chair Jerome Powell last week. He talked about concerns over stagflation. Today, we had the IMF downgrading US growth forecasts, but interestingly, not expecting a recession. What's your outlook? What do you see as the impact of these trade tariffs?
Yeah, the IMF only downgraded just to about 1.8% this year for the United States. Yes, they downgraded China by a significant amount, as well as the global economic growth forecast. But I think that they're going to be forced to cut again. The US is unlikely to grow above 1.5%. In fact, I think there's a very good chance, Fiona, that this year we see recession. A lot of what we're seeing in the data is indicating as much. In fact, the soft data from January through to date has indicated an economic deceleration that's strong. What we have yet to see is this come out in the hard data. But I believe we're in an inflection point this week as hard data is due to come out with durable goods and capital goods orders, aircraft and defense spending. That number, Fiona, goes direct into the calculation of United States real GDP. So those two numbers I'm expecting to come out, indicating that we have seen economic downturn, and we should expect hard data to corroborate soft data in coming weeks and months.
And so, how are we seeing this being played out in the US dollar, in the Treasury markets? What are you seeing? What movements?
It's a fascinating decoupling between the Treasury yields, 10-year Treasury yields and US dollar. We've seen yields surge and the dollar enter a bear market, which is quite fascinating because really that puts into question the safe haven status of the US Treasury market, which historically has always been the case, where you get yields getting juicy enough and the risk free asset to attract flows into the country. And to right now, we're not seeing that. So I think the reason for that is a combination of things. One, of course, it's the Trump risk. People are saying that the president's erratic policy is causing a reevaluation of how risk-free the U.S. Treasury is. But I would argue that it goes beyond President Trump. I think Trump was the flame that, the little spark that lit this flame, but we had a lot of accumulation of disequilibriums in the United States in terms of fiscal, in terms of debt, and on a global scale. But I would just finally point to one thing, Fiona, which I think is important and not talked about enough, which is that the U.S. Treasury market, the main owners of the Treasury market have now diversified, and the main owners of Treasuries are the private sector, not the global entities, the central banks. Central banks were a huge holder. Now they're smaller, and that's important because central banks, China, Russia, Saudi Arabia, Japan, are price insensitive, inelastic to price, and private sector is not. So when you have the demand for treasuries not as strong as it was, and you have supply that is still exorbitant, then you get treasury yields moving higher, price moving lower. Combine that with a lot of fear in the markets, and you get risk premium that moves higher in the treasury market. So I don't think this is something that's going to go away anytime soon. I do expect the long end of the U.S. Treasury yield to continue to move higher, and the dollar to remain weak until we get some clarity with regard to these trade deals and tariffs.
So interesting. And then returning to trade, I mean, do you see this as the end of the free trade model?
It's interesting because we don't have free trade right now. So this is not like we're operating in a vacuum, and the world was trading under free trade terms until the reciprocal tariffs, and the additional tariffs. The reciprocal tariffs are such, the reciprocal. So there have been barriers for a long time. And I think what's happening now is a pursuit to try to improve the terms of trade. But what happens, Fiona, is that we're going beyond that. and we're seeing damage in the United States. So we're probably are going to see a recession because of what's going on. I'm just looking at my data here. US ISM non-manufacturing index is due out this week as well. It's already moving lower, and I suspect it's going to go into contractionary territory. Service sector in the United States is all important. Consumption is all important. This Friday, we get the University of Michigan Consumer Confidence Survey, and that's going to show the fifth consecutive month of deterioration in consumer sentiment. Consumption is 2/3 of the US economy, so when we
Yeah.
expect consumption to slow down, the service sector to slow down, and we also know that corporations are pausing their capex expenditure because of uncertainty around tariffs. I think we can conclude that there's a very good chance, I put it above 50%, of the US going into recession this year. Base case, Fiona, stagflation, good chance recession.
No, so much to be watching there. And I guess the final thing just to touch on here, we've seen a ramping up of rhetoric between or attacks from Trump on Federal Reserve Chair Jerome Powell. Do you think that's significant in any way?
I would put the significance lesser than perhaps what is getting spooking the markets. He's not going. President Trump, in my view, is not going to fire Powell. He's going to replace him for sure, but he's going to let him serve out his term. Remember, in Trump 1.0, we heard similar rhetoric. Trump put Powell in that slot. He is going to replace him, but not before his term ends. So I don't think we're going to cross that threshold as yet. And we should expect the Fed to not cut rates because the president is pressuring him. Again, we've heard this from the president before. We've also heard it from Elizabeth Warren and the other side of the aisle as well. So anyone can say anything. Anyone can say anything. It's of course more important when it comes from the president, and he is trying to get lower rates. But I think it's pretty clear that a lot of his own policy making is creating this world of higher rates and a weaker dollar. So I suspect that we're going to get some pushback and some reversal of some of these policies, Fiona, because these policies are having the opposite effect of what the president's goals are, which are to bring the 10-year Treasury yield lower, make life more affordable, make housing, financing your house and buying a house and the purchase of products more affordable, not less affordable.
No, brilliant. I mean, you've given us so much to be watching out for once again, Kathryn. Thank you so much for your time.
Thank you, Fiona.
For more videos like this, please do like and subscribe.